Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for September 20th of 2021. Please see our disclaimer for important information. Well, as we get started this week, we take a brief look at our COVID tracker, which posts our 7-day moving averages for both daily new positives as well as daily new deaths. As we can see, we have seen a slight little uptick in the most recent trend. We were talking about this over the last couple of weeks and wanting to guard against perhaps a false peak perhaps. And you can see back at the end of the year, we had a couple of false peaks and then only to reestablish higher peaks a little bit later on. So obviously we're monitoring the data. Some of this has to do with school reopenings. We do know that daily deaths look like they're kind of perking up a little bit, but again, most of these are for the unvaccinated folks, but we are seeing some breakthrough cases and clearly some news this week that I think the FDA is interested in holding off for the most part unless you're in a more vulnerable age or medical cohort on the booster shots for the time being. As we look at our high frequency data from our friends up at First Trust in Chicago, we can see that we've had a bit more noise in the data. I think we're hitting a seasonal lull in traffic, both at the airports as well as motor gasoline. We're obviously just not driving as much or flying as much as we were, and that data is a bit soft here. Open table restaurants, I think this is a better indicator of what's going on with the Delta variant. In that not only are we down rather pronounced for the week, but also reasonably for the month. As you can see here on open table, we're still about 15% below 2019. TSA checkpoint data, we're still almost 30% below. And commercial flights, we know inventory flights are lower. Again, not too surprising, but I think the open table number is probably as relevant as any as an indicator of the more near-term impact of the Delta variant on activity out there. We also see some data related to rail car traffic. It looks like maybe in some respects that some parts of the supply choke points are beginning to break. You'll see that in a little bit, but clearly we're not necessarily seeing as much activity as we were earlier this year overall. Well, as we transition into economic data, here is the Citigroup Economic Surprise Index, and Citi does a wonderful job of kind of characterizing kind of the ebb and flow of the data and giving us a tone for what that data looks like. And obviously coming out of the pandemic, we were very positive, lots of positive surprises as we were recovering a lot faster than we thought we would, and those have tailed off. And now we're beginning to see a kind of a pronouncement of negative surprises out there, and you can see these little bubbles. These, if you go back years, and this data series goes back to about 2011, you can see these trough points, and barring the dip that we saw last year related directly to the pandemic, we're kind of at that point now. So there's an argument to be made that maybe we've seen the worst of the kind of the disappointing data, and that we're perhaps setting ourselves up for a little bit better data heading into the back half of the year and into the beginning of 2022. Here's a quick look at retail sales, and this is a control group. So this is not the broad index, but it's a control group of items that make it a little bit easier to track, and you get, I think, it's not as broad an information set, but it's certainly a reliable information set. And you can just see the profound rebound that we've seen in retail sales, and you can actually see the noise a little bit at the end here, where we've kind of, our growth has ceased. To a large degree, and we kind of moved sideways on retail sales, but that's not to say that they're negative, and they certainly haven't turned down. There's still an interest in spending. It's just not as robust as we saw earlier this year. And we are, and just the other point here is that we're above that trend line by a pretty fair amount. And this has been a profound influence on the economic growth that we've seen over the last year. Now we've got a lot of data here, and this is all really from the Philly Fed. And so this is kind of giving us some real-time updates on a lot of the stuff that we've been following. There's a lot of Federal Reserve districts. This just happens to be the Philly Fed. You can see, in no particular order here, we've got manufacturing unfilled orders going down. So that's the latest reading. So we've seen a moderation in unfilled orders. That tells us that the choke points might be moderating a little bit, as we alluded to earlier in the broadcast. Manufacturing index is perking up a little bit, but with unfilled orders going down, that tells me that we're getting more throughput out of our plants. Now, the one thing that we're seeing here in the lower right is the expected activity in 6 months. And it does show a drop off to some degree. Again, this is a diffusion index, so it's not telling us that there's going to be outright contraction. It's just telling us that there's going to be less activity in manufacturing 6 months henceforth. But that, if you look at the upper right, that may corroborate with this because it's an overlay. In the dark line, it's basically the leading lagging indicator, basically like a leading indicator, but it typically leads by about 10 months. And you can see in the light shaded color there, that's the ISM, the Institute for Supply Management Manufacturing Survey. And you can see that that's still relatively high. But with the Philly Fed rolling over as it has, and leading by 10 months, that tells us that, frankly, that 2022 is going to be a bit more benign. I mean, this data series has a pretty good predictive relationship, and I think what it tells us again is that the activity next year is just not going to be as robust as we saw this year. Nothing wrong with that as long as we can continue to foster the conditions which would lead to growth. And at this point, there's no reason to think that that's not going to happen. This is something that we've been monitoring for some time. Again, with the freight and shipping choke points, there's lots of container ships that anchor outside of ports that cannot be processed for a lot of different reasons. Freight costs have gone through the roof. There's all sorts of reasons why. You can see that this is, something that's been in the mix for well over a year now, but it's really taken off in the last several months, and it will find its way into end prices for the consumer. All right, quick look at labor here. So we did have the cessation of the emergency unemployment insurance benefits, and so you on the left-hand side, you see that trend line still moving down on initial claims. Say the data on labor continues to look good, but there's still a lot of jobs that cannot be filled right now, and labor is still a problem for a lot of small businesses. You can see on the right side that despite the drop in the unemployment insurance claims and initial claims in particular, we see a real interesting divergence happening here. So you've got in kind of the amber color, you've got the JOLTS job openings, and these are millions of jobs that are open right now. I mean, we're talking like 11 million jobs. And then that's overlaid with the unemployed persons, and these are people that are deemed to be unemployed, not necessarily underemployed, but just out of work. And you can see that there are actually more job openings than there are unemployed persons available to work. In fact, the most recent ratio is essentially 5 jobs for every 4 unemployed workers. So one would think that in a vacuum that didn't include the COVID, didn't include some of the issues related to that, like childcare, things like that, that this number would look a little bit better, and it would look a little bit more normalized. Again, you typically see more unemployed people than there are jobs, but in this case, they're plenty of workers out there and plenty of jobs to match them, and we're just not seeing that kind of those synapses connect out in the real world right now. Now we will transition to inflation. We've got two different views of this. We've got consumer and we've got producer inflation. On the left-hand side, we've got essentially a view of both the all-in personal consumption expenditures index, or PCE, that the Fed really pays a lot of attention to, both in the overall number as well as the core, which excludes food and energy. And you can see that, that excluding the more volatile items smooths out the data a little bit more, but you can see that pronounced uptick in inflation there on the right side of that chart. And this is everything that we've been talking about, all the pass-through inflation, all the inflation that's tied to some of these reopening service sectors like hospitality, rental car prices, and things like that, all moving higher, even within the control group again. So if you back out the more volatile items, we're still moving higher, even though the overall inflation that we're seeing in the core group is not as high as it was really over the last 5 years on average. So that's a positive. Now, if you move over to the right, then that's producer prices. And this is what I was talking about earlier with freight and container costs moving, essentially going through the roof. That's where all of this stuff is manifested here. It's in the producer side. You can see both the overall PPI, producer price index, as well as the core PPI, which again excludes those volatile food and energy items, that those are moving significantly higher. And so there is a bit of a lagged effect, and there's also a mix effect too in CPI, that the consumer price index, or CPI, has a fairly strong weighting, over 30% related to housing and owner's equivalent rent. And so, and these things aren't really captured in the PPI just by their construction. So the CPI and the PPI don't always move in tandem. Directionally, they're moving the same way right now. But again, the core consumer prices are still a bit below where we've seen them over a longer period of time, even if the overall all-in number is higher. This is an interesting chart off Bloomberg, and it really caught my eye. It was off a Twitter feed made by Bloomberg, and this is a plot of real average weekly earnings. So this is basically earnings plotted against inflation. And in this particular tweet was talking about the inability to meet the inflation rate. Again, we're seeing a lot of inflation at the producer level. We're seeing it on an all-in basis on the consumer side, as we just saw in that last chart. But here, interestingly enough, we haven't rebounded completely in weekly earnings. Now, we know earnings are moving higher. There's a labor competitive issue. Employers are having to pay up, and bonuses and higher wages and things like that for talent. But right here we can show you this disparity, which is it's erstwhile unusual. I mean, we do see periods where inflation is higher than wages, and then we also see it in the opposite here. So there's, in some respects, kind of an opposite relationship, and a bit of a cause and effect here too, because overall inflation will tend to drive up wages at some point. And right now we're just at a really odd juncture. We haven't seen a delta between inflation and weekly earnings since the great financial crisis, which is a shaded part over on the left side of this graph. And so, it will be interesting to watch wages here in the coming months. These data points are going to be pretty meaningful to see how well consumers are able to offset inflation with higher wages. Here is a chart on credit and debit card spending at restaurants. And again, this is probably as much a high frequency indicator as anything else, but it's showing you the trend line of the high frequency numbers that are embedded in that first chart that we always look at from First Trust. And here you can see that spending at restaurants over really the last 5 months has kind of tailed off. So there is some impact from the Delta variant here. There seems to be a bit of a moderation overall. Some of this has to do with, again, the inability for restaurants to find workers. And so there are a lot of cases, even back as, recently here is like May and June, where restaurants were only operating at, in some cases like 25 to 50% of capacity because of a lack of workers. And so naturally, as a result of that, you have seen lower spending overall because there's lower capacity available. But then again, the Delta variant is kind of adding an extra anchor onto that right now. I thought this was really interesting because it plots a lot of it gives you a sense of kind of where the world is right now. As we look across the ponds and look at international investments and things like that, I mean, this is a plot of where, essentially the world is from a PMI, which is an indicator of economic growth. So, the ones up at the upper left, or excuse me, the upper right, are, countries that are expanding and accelerating, and then the x-axis is the manufacturing PMI, and the y-axis is basically the manufacturing side, and it's the actual number itself. And so what you see is that you've got expanding countries. U.S. is in that basket. South Korea, Taiwan, Poland. You've got expanding and accelerating, which is Hungary, Turkey, Colombia, India, and then China at various points fits into several of these different quadrants. But then the countries that are both contracting and decelerating include the Philippines, Mexico, Russia, South Africa, and these are all. Some of these are Asian countries that have dealt with the Delta variant. Some of these are countries that have kind of systemic economic inhibitors to growth. China is actually in that basket right now. There's a lot of speculation over China and its growth rate. And we'll see a chart here coming up where high yield bonds spreads have really widened out in China because there are some fears of kind of a pronounced slowdown. As we think about the future of work and particularly the future of office, I was reading an article in The Economist which essentially plots this trend of remote working, and this in particular kind of refers to tech workers, and it just shows you the dramatic change that we've seen even as COVID was beginning to take form. I mean, these numbers were already changing, but you have essentially a complete shift in remote versus on-site preference. This particular chart here plots job postings that are advertising either or remote versus on-site. And what's really interesting is that, and I think this is telling because it's going to have some staying power, is that the on-site number is very low. I didn't think that it would move this low, but 25% is as low a number as we've seen. In fact, it's usually above 60. And so, this just happens to be tech workers, but these are the folks that were pioneering the remote working environment long before people in other industries were. Getting back to China, this kind of highlights a couple of things, at least one thing that I mentioned earlier, and that's the high yield index. And there's a cause and effect here. So if you look at the left-hand side, there's regulatory actions China's making a lot of waves about wanting to rein in some elements of the free enterprise, or what they characterize at least as free enterprise, and reining in real estate, reining in for-profit education, those types of businesses, and they're really coming down hard on some of these companies that are led by these tycoons that have amassed a lot of personal wealth that have become a little bit more outspoken against the government. So there's more regulatory actions at a time where we're seeing some slowing in China, and some of it's manufactured actually, manufactured slowness, and that's manifesting itself into higher yields on high yield. So you're seeing that impact is driving spreads wider and decreasing the price of those high yield instruments. Here is a plot of essentially technology versus cyclicals, and we were talking a lot last year, particularly about this time last year, about the emergence of a new cycle, a new economic cycle, and when that happens, typically you have cyclicals. As its name would imply, you have cyclicals that take the lead, and they most certainly did that, particularly at the end of last year and into the beginning of this year. And you saw technology stocks take a bit of a pause, and lately, we've seen cyclicals kind of take their own pause, right? Because we were not as in rapid growth mode as we were at the end of last year and the beginning of this year. And so you see those stocks traded maybe a bit more sideways, and we've seen technology again reemerge its leadership in the market. And I do think that as we kind of settle out here, we've got supply chain choke points, we've got this interim bout of inflation, which I think elements of will certainly be transitory. When that works itself out, the cycle can resume at a lower pace than what we've seen. And I do think cyclicals are going to reestablish some credibility in the market relative to technology. But you can see here that they have treaded water just a little bit here over the last couple of months. Here's another look of inflation, and this happens to be rent, and as it ties to consumer prices. We've got several iterations of this. So on the left-hand side, we've got rent inflation as it's decomposed, and you see contribution from small cities and seasonal adjustment factors, but you're definitely seeing rent inflation finally pick up. And we know with house prices moving higher that is typically at a few months lag, and so we're definitely seeing rent inflation moving higher now. If you look over at the right-hand side of this chart, you've got apartment rents that are moving higher. We know that owner's equivalent rent is a significant part of the CPI and an even bigger percent of the core CPI. Apartment rent, you can see those numbers moving higher on a year-over-year basis, and then you can see down below that you've got another view of this that time series that actually goes back to 1996, and you can see the variability, and you can see the degree to which the Case-Shiller has moved out in advance of those rents. And we do think that rents are going to continue to move higher, which will have an influence on overall inflation. Quick look at the dollar. Say that of all the stories about the market right now, the dollar is actually the most boring story because it's kind of found its channel. It's trading in a range, and not a whole lot of impetus to break out because we were seeing a little bit of strength earlier this year based on the fact that U.S. was emerging and we were still having vaccine and virus challenges and elsewhere in the world. That has kind of evened out now, and the U.S. is showing slowing down just a little bit. And so there's really not a lot of impetus for the dollar to go necessarily higher. There might be a little more impetus for the dollar to go a little bit lower as some of these other countries and areas around the world begin to kind of find their footing. But really, dollar's trading in a channel right now, which has very little kind of predictive power at the moment. This is a quick look at the 5-year Treasury yield. Essentially over the last week, we've seen the yields move a little bit higher at that part of the curve. Again, breaking out a little bit of a trend that we've seen here lately. Here's a yield gap between the 5 and the 30-year Treasury. And so in that last slide, as we showed you, the 5-year yields have moved up a little bit from their trading channel. We've seen a stubborn back end of the curve, meaning that yields are not moving necessarily higher. In fact, this narrowing gap would really tend to suggest that the inflation expectations are moderating. When you see this chart expanding like it did, essentially from the beginning of this time series in September of 2019 all the way through March of this year, that would tend to indicate expectations of more pronounced growth that would lead to inflation. And here this shows that the inflation expectations are moderating just a little bit. So here's a 30 to 10-year government bond spread, and those are also moving lower. So I showed you 5 to 30, and this is 10 to 30, and so this is just reinforcing kind of the comments that I just made about the expectations. And actually, you can see that in this chart on the right from B of A Global Fund Managers survey. So this is institutional investors that are offering their opinions on inflation, essentially. And so you can see that there's a relatively high number that believe that the inflation is going to be transitory, although a few more of them believe that there's going to be kind of a permanence to this. And this is kind of gets back into that soft zone that I've been talking about, that inflation will likely be higher than it has been, but the question is how much. And so the change in this reading would tend to suggest that there's a few more people that feel like inflation, as it settles out, it's going to be a little bit higher than originally thought. I don't think it's going to be outsized, but again, if you go back to the chart on owner's equivalent rent, and we know rents are at a lag, and we know rents are moving higher, that's a component of core CPI. And I do think that has some staying power. I do think some of the logistical and choke point related inflation that we're seeing, like container shipping, that will roll over, just as some of the inflation that was born out of kind of the reopening of the economy, so to speak, also had an influence. But at least this is what gives you a snapshot of what institutional investors are thinking. I thought this was really interesting from Deutsche Bank, and it just shows you the trailing S&P 500 price to earnings ratio. And there is a lot of discussion out there about the market valuations being high, and that's certainly is the case, even though multiples have come down a little bit. And you can see that over on the far right hand side, but they're still above a trend line, still above this long-term average of roughly 16 times. And you can see, they've got the standard deviation bands kind of in these dotted lines on either side. It just means that we are in somewhat rarefied territory right now, that valuations are higher certainly than we've seen in some time. And you see, in these areas, leading up to this, and this time series goes all the way back to the Great Depression, that when you see these bouts of value increase here, price to earnings and PE ratio increases coming out of recessions, it's actually not uncommon. And that's exactly what we saw. And so this would tend to suggest that we're going to have a moderation of PEs here lately. If you go back to essentially, the mid 80s, we really haven't spent a lot of time below that average PE. We certainly did after the global financial crisis, but we really haven't spent much time there. And so, the thought is, what is a more normalized kind of a modern PE that we should be aspiring to? There's a lot of debate on that, and I do think that it's lower than where it is now. But I do think that earnings will eventually catch up with the multiple. Earnings will catch up with prices, and so the multiple will eventually come back in line. But for the time being, though, earnings have been robust, and it continues to essentially move higher and faster than prices have been. So the multiples actually come down. But over time, we do think that as inflation and interest rates move a little bit higher, that takes some of the gas out of stocks, and that you'll see that trailing PE begin to moderate a little bit more. This is a indicator. It's the AAII, American Association of Individual Investors. It's basically a retail sentiment indicator. You can see here that retail investors are a little less optimistic than they have been. It's a diffusion index, so anything that's negative represents kind of a negative expectation, if you will. So, and this is, I think, kind of a culmination of a lot of the noise that we've seen in the market related to Delta and some of the impacts on some of the near-term economic data. Of course, when retail investors tend to see that kind of data that's not necessarily reconfirming of a long-term positive trend, then they get a little bit more suspicious and cautious, and that's essentially where we are right now. This ratio moves around a lot. And it's highly influenced by kind of real-time data. So if we assume that the Citigroup Economic Surprise Index is maybe bottoming out, maybe we get a little bit better than expected, or at least as expected data, and some of this negative stuff kind of filters out, that I would expect this bull-bear spread to kind of perk back up again. I thought this was really interesting from Indeed, and with all of the conversation in the market right now about vaccination cards and mandatory vaccinations, and there's really visceral arguments on both sides of this equation. But I saw this chart and knew that I had to share it because it just shows you this massive spike of job postings through Indeed where vaccination is being required, and it shows you this transition point where Pfizer's vaccine received its full FDA approval, and of course we're waiting on Moderna. But even in advance of that, there were a lot of companies out there that are mandating vaccines. And our last chart of the day was something I came across in a Fidelity chart pack that they did a deep dive into basically the drug industry. And what's really interesting on the left is you see FDA approvals of new molecular entities, essentially new novel designs, and essentially new drugs, basically. And you can see that this trend line has been evolving for several years, and you'd argue that in 2020 it would have been higher, except everybody was focused on the COVID vaccine, almost in lieu of other things. But on the right hand side, you can see that the compound average growth rate in new R&D, or research and development projects, or at least projects in a developmental stage of production, is moving at a reasonable clip. So there's a lot of R&D in the pipeline. There's actually a fair amount of increase in the rate of approvals. So there's more compounds treating more treating more a range of illnesses. We do know that there's a lot of areas that are receiving a lot of interest right now. different therapeutic areas that are receiving a lot of attention right now. But it's good to see that there's a lot of R&D and that the FDA is processing those applications in more reasonable timeframes than we've seen in the past. That's all we got this week. I hope you've enjoyed the chart pack. On behalf of the entire team at BKA Wealth, hope you have a safe week, and we will talk to you again soon. Take care. Bye-bye.